Hey y'all, we're back with Progressive Sisters Magic, and today we're moving into lesson 4, the fundamental analysis of the crypto market. So in the last few lessons, I've taught you what cryptocurrency is, what it's used for, the type of wallets there are, the type of exchanges there are, the do's and the don'ts, some of the do's and the don'ts, because there's a lot of do's and don'ts in crypto market, okay? But now today we're going over the macro and the micro fundamentals, economics of crypto. And when I'm talking about macro and micro fundamentals for these cryptocurrencies, I'm talking about how things in the world can shape the crypto market, can make or break the crypto market, okay, you guys? So you guys need to know everything that will be happening economically, policy making, new laws, just anything that's being created that will have a direct impact on the crypto market, so you know when it's best to invest and when it's best to rest. I was rhyming. So with all that said, let's go ahead and hop into the very first part of this lesson, which is going over why the fundamentals of crypto actually matter. Fundamental analysis, FA, looks beneath price charts to judge whether a crypto project has real value and staying power. In the current market environment, FA is especially important because many investors are buying for the long term, institutions are participating more, and global macro events move capital flows quickly. FA helps you separate tokens with real utility and credible teams from speculative or fraudulent projects. And it helps you place trades with a view of how external events, economic data, geopolitical crisis, or a big tech stock move may change market sentiment and liquidity. Okay, you guys, so as you can see, these FA or fundamental analysis are super important for crypto because it gives you a sense of direction on what direction the market is going. And if you're doing any long-term investing, any swing trades, any day trades, or just any investing in general, you need to know what's going on in the market so you can know how to plan your trades. And another reason why understanding these fundamental analysis is super important in the crypto world is because it allows you to understand your portfolio. So when I say your portfolio, I mean all of the crypto investments that you have, okay? So if your portfolio is doing bad, if it's going down by a lot, instead of panicking and doing panic selling and losing out on maybe something that could be profitable in the future, you can look at the macro and micro economics that's happening around that time frame, and you can try to understand why the crypto market is doing that. And that knowledge can be used to make a sound decision for whether you want to stay holding that asset, if you want to sell that asset, or if you want to buy into the dip, okay? But knowing all these external information is going to greatly help you to understand your portfolio and your investments in general when it comes to cryptocurrency. So there are thousands of crypto projects that exist in the crypto market, okay, you guys? But not all of them have utility, which means not all of them have a purpose or a real use case scenario that they can go behind, okay? That means that a lot of meme coins are inside of the crypto markets. And that means that anybody in this world can make a crypto coin. You and I can both make a cryptocurrency. That doesn't mean that it has any utility, any institutions, any real money backing it. It just means that we got creative and we put our thoughts onto paper. So it is imperative that you understand what utility is, how to spot utility in a token, and how to spot a fraud, okay? Because there are a lot of fraudulent things that happen in the crypto market, which is why it's labeled as the most riskiest asset to put your money into. Every single crypto exchange or crypto website is going to have it plastered somewhere on their site telling you that crypto is a risky investment and highly volatile and very unpredictable, and you're investing at your own risk, okay, you guys? So let's go over some utility tips that we can go by to make sure that whatever you're investing in actually has potential. Use case and real utility. A useful project solves a concrete problem. Ask, what real world or blockchain native problem does this token solve? Is it a payments token, a governance token, a gas token for a platform, or a utility for decentralized finance, DeFi, or NFTs? Projects with strong, demonstrable use cases, not vague, disrupt everything marketing, are more likely to retain value over the long run. Look for live products and measurable metrics such as daily transactions, active addresses, or TVL, total value locked. So when referring to the different type of cryptocurrencies in the market, we're going to be referring to them as projects. And that's essentially because that's what they are. They are projects, okay? They are something that needs funding, that needs support, that has a problem that needs to be solved, that is actively trying to solve that problem, that has a real life use case for it that can be demonstrated in the real world, etc. Okay? So it's literally a project, like how you would go to the science fair and you have all these different science projects with their different hypotheses and their different theories on how they're going to prove their hypothesis, the empirical data and everything, and like evidence they have backing it, okay? And they're trying to essentially sell that idea of that project to you so that they can win the science fair, okay? That's exactly what's happening in the crypto market. And it's not essentially them trying to win a competition within the crypto market for these cryptocurrency projects, but more so is them trying to tell you what they're about so that maybe you might think about investing inside of it because you resonate with the utility of the token itself. So don't get it confused. While crypto is a decentralized type of digital currency, it's not decentralized or unattached from the world, okay? The world still has a huge impact on the crypto market. Anything that's happening economically or politically or just financially in the world is going to have a direct impact on the crypto market. Whether that be only for coins in a specific sector like technology or aviation, or it be just the entire crypto world as a whole, depending on what's going on, okay? But they are not excluded from anything that's happening in the world. Just like things and news affect stocks and commodities like gold or silver and things like that, it's going to affect the crypto market as well. Now let's do a bit of a deeper dive inside of what I'm talking about. Macro and news drivers, how global events move crypto markets. Cryptocurrency prices are not isolated. They respond to the same macro forces that move other risk assets, and sometimes they amplify those moves. Macro fundamentals are the big picture economic and global factors that influence the entire financial market, including crypto. Unlike project level fundamentals, team, roadmap, tokenomics, macro fundamentals come from world events, economic reports, and government decisions. These include things like US inflation data, CPI or PPI, interest rate policies by the Federal Reserve, job reports, stock market performance, S&P 500, NVIDIA, tech stocks, gold and dollar strength, and even wars or political tensions. So fun fact, you guys, news is so important when it comes to any financial market that traders actually trade news. Like they actually trade news events. They wait for these reports to come out and things like that, and they trade a specific market that correlates with those news. So it's extremely important to understand these news, to understand when these news actually come out, because some of these reports and things like that, they're not random at all. They're planned, they're on a schedule. The Federal Reserve meetings are scheduled. You have access to it. You have access to the transcripts. And even if there's a call, you have access to that as well as like everything that happened after the call. So it's like these things are not secret. Now, there are some information or some news that just pops up and it's just like, oh my gosh, and it rattles the market a lot. But for the most part, these news are actually planned, and it's like a news calendar that you can also see on Yahoo Finance or just like TradingView or your brokerage account that will let you know when these reports and when these news moving things are going to be coming out. So now let's get into some of the specific type of data and reports that are going to be released about the economy that have a direct impact on the crypto market. US economic data, CPI, PPI, jobs, inflation, and interest rates. U.S. economic releases are major liquidity and sentiment drivers because they influence monetary policy expectations. For example, Consumer Price Index, CPI, and Producer Price Index, PPI, inform how fast inflation is moving. Higher than expected inflation increases the chance that the Federal Reserve will hold rates higher for longer, which usually reduces risk appetite and can push down risk assets, including crypto. Conversely, cooling inflation can raise hopes for rate cuts, improving liquidity and often lifting both equities and crypto. Traders watch the U.S. monthly economic calendar closely because even small surprises can cause rapid repricing across markets. Institutional participation links crypto to traditional markets, so CPI/PPI moves often produce immediate volatility in Bitcoin and major altcoins. Okay, now let's go over a little bit why these things are so important. So when you have things like higher interest rates, that means essentially that they are trying to stop people from borrowing so much. An interest rate is basically essentially how much you're going to pay to be able to borrow, okay? So when you have interest rates on a mortgage, on a car payment, on a credit card, all those type of things are literally going to be linked to how much you're going to pay to be able to borrow. So if they're trying to fix an economy that just has all finances out of control, they are going to higher those interest rates, and that is going to make people not want to borrow, and it's going to essentially make people take money out of risky assets like crypto and put it in safe havens like gold. Okay, so commodities like gold and silver and just different oil and things like that, they're going to be considered safe havens. Okay, so that is a safe asset to put your money in, to have it there no matter what's going on in the world. Now, when the economy is doing good, they usually take that money out of gold because it's no longer a risk that's happening for them to put it in other things, and they go and they put it in other things like crypto or stocks and things like that. So the greatest correlation I can make to this is when the economy is doing really, really, really good, I guess you can say that crypto markets are going to be doing good. When the economy is doing really, really, really bad, crypto markets are not going to be doing good. They're going to be doing probably really, really bad because people are going to be taking their money out of something that's very risky and putting it in something that's more concrete and confirmed, no matter, so they have protection against anything that may happen in the economy. But that is not how it always goes, okay? So the economy can be doing really bad and crypto be doing really good, or the economy can be doing really good and crypto could be doing really bad, okay? Because there's so many other factors that is going to be influencing the price of these cryptocurrencies. You can't just pinpoint everything to just one factor, which is going to be the CPI reports or PPI and things like that. But they do have a major impact and influence on the cryptocurrencies prices, okay? So when it comes to interest rates and inflation and things like that, and Federal Reserve meetings and them doing whatever they're going to do, either slashing the rates or holding them still or rising the rates, is going to have a direct impact on cryptocurrencies. So now I just mentioned the Federal Reserve, so let's get into our second topic, and that is going to be the Federal Reserve and interest rate expectations. The Fed's rate decisions and forward guidance determine the price of money. Rising rates make holding speculative, non-yielding assets less attractive. Lower rates and quantitative easing expand liquidity, which can drive money into risk assets, including crypto. Market pricing of rate cuts or hike Fed funds futures often correlates with near-term crypto moves. Because crypto is frequently treated as a risk-on asset by many institutional portfolios, signals of looser monetary policy can often help support rallies. So once again, you guys, crypto markets are decentralized finance. They are DeFi. So the less rules placed on DeFi, the greater it's going to be. The higher the prices are going to be, the more income and revenue that's going to be generating inside of these cryptocurrencies, okay? So the less rules, the better when it comes to cryptocurrencies. The more rules and policies and cuts and things that you're going to be doing to have to deal with monetary policies in general is going to directly affect cryptocurrencies, okay? Now let's get into the economical effects of stocks and equities, okay? Because they also have a direct impact on cryptocurrencies. For example, whenever technology is doing really, really good, like an NVIDIA stock soars, you're going to possibly see something like XLM or something like that having to deal with technology that's also going to soar and go up with it as well. So let's go into how that exactly correlates with each other. Major equity moves in large stocks: S&P 500, NVIDIA, tech sector. Crypto has shown periods of high correlation with major equity indices, especially the S&P 500, as institutions allocate across risk assets. Large cap tech stocks, including NVIDIA, can lead sector flows. A tech-led rally driven by AI enthusiasm, for example, can lift risk appetite broadly and create spillover into crypto markets. Conversely, equity drawdowns triggered by earnings disappointments or sector rotation away from tech can reduce liquidity for speculative assets and weigh on crypto prices. Recent analysis have documented stronger correlations between Bitcoin and the S&P 500 during risk-on periods. So like I stated before, when you have different sectors that are rallying because of earnings or because of something big and major happened for a specific major company or something like that, it's going to directly have an impact on the crypto markets. So a lot of different crypto projects are going to be tied to something in the real world, whether that be gold, whether that be oil, whether that be technology, transportation, education. There's so many things that these cryptocurrencies are tied to, directly tied to. So when something is going on in the real world, in those real world markets, like let's say crude oil or something like that, all the crypto coins that are tied to oil or commodities in general will see some type of reflection of what's going on in the real world market. So speaking of things being tied to the real world, let's jump into gold and why that is named a safe haven when everything else fails. Gold and safe haven dynamics. Gold is a traditional safe haven asset. Crypto's role as a safe haven is still debated. At times, Bitcoin and gold move together, both rising on macro uncertainty, while at other times they diverge. Academic and market studies show that during some crises, crypto behaves like a risk asset rather than a safe haven, while in certain episodes, gold and Bitcoin have been complementary for portfolio diversification. That means investors should not assume crypto will always protect capital during shocks the way gold often does. Monitor the gold-Bitcoin ratio and cross-asset flows to judge when investors are seeking safety versus pursuing yield. Okay guys, so now I'm going to give a real-world recent scenario of how gold and Bitcoin will interact with each other when we have an economic crisis. So this past weekend, there was a lot of war tensions going on in the economy and just a lot of things happening in the world between the United States and the Middle East and things like that. So that means when people get scared, they put their money into safe havens like gold and they take it out of risk assets. Now, Bitcoin currently is down and gold is up. Okay? When I say up, I mean up. Generational wealth, while Bitcoin is actually down. Okay, so that is not how they always correlate with each other, but in some instances, a lot of investors will take their money out of risk assets that don't necessarily have a clear path of what they are yet because it's still relatively new. You know, crypto market is very new compared to the stock market or to the futures or commodities market. Okay, so it still has some traction to be able to get up there and be considered a safe haven, but right now a lot of investors do not see it as a safe haven, especially since it's decentralized, and that means that it's a lot less rules and a lot less policy surrounding it. Okay, which means there's a lot less protection over your investment. Another real world example is when we had the tariff war with China. Okay, so when all that was happening with the tariffs and Trump putting tariffs on China and China putting tariffs on us, Bitcoin was down. Okay, it was so down, but gold was so up. Okay, because when you have tariffs and things like that, that is just showing that it's a lot of things going on economically, and then it's just like not in our favor. Tariffs on us are never in our favor, and tariffs on other countries kind of seem like we have some tension with them, something's going on, and it can interfere and interrupt our trading and things like that as far as commodities. So then that puts a little bit of anxiety inside of investors, and they take out of risky assets like crypto and put it into more sound, concrete assets like gold or silver or just a lot of things in the commodities index. So now let's go into geopolitical events and the risk of war and how it has a direct impact on cryptocurrencies. Geopolitical crisis, major wars, sanctions, large-scale conflict can produce immediate volatility in energy, commodity, currency, equity, and crypto markets. These events cause short-term risk-off moves and liquidity shifts, and they sometimes change regulatory or on-ramp/off-ramp dynamics. For example, sanctions affecting crypto flows. Empirical work shows global geopolitical risk shocks negatively affect traditional equity returns and can transmit to crypto markets, but the direction depends on how investors interpret the event. Flight to safety versus convulsions that disrupt markets. Always track an independent geopolitical risk index and note how markets respond in the first 24 to 72 hours. So basically what that was saying is that geopolitical events and risk of war are going to have a complete impact on cryptocurrency, on the crypto market. Now, the direction of that impact, you have to wait and sit it out and see the direction, okay? Because you're not the only person who's going to be moving their money or putting more money in there or just holding their money in there. You're still trying to see what you want to do, but you need confirmation from the market, okay? You need confirmation from the charts. What is the price action doing and things like that? Because you don't really know essentially which direction the market is going to go based on a certain news event. You can have a thought of where it's going to go, but there can be other factors that are all happening at the same time that push it in a complete different direction. So as a trader, as an investor, you need to know, so you need to wait for confirmation, okay? Don't just jump in a trade or jump into a market because something big happened. You know, oh, they announced wars happening, and you jump into the oil or the crude oil market not knowing anything, not knowing what position you're in, just like blindly doing it because there was news about it, okay? Don't do that, okay? Wait for confirmation and wait for evidence that that is the direction that it's going and that it's going to continue to go in. So these news can work for you or can work against you in the crypto market. It's all up to you and your knowledge and your dedication to understanding the knowledge and which way it's going to work for you, okay, you guys? So when I say that, you need to be up to date with the dates of these releases are going to be. The CPI, the PPI, the different indexes and things like that. They have different information that is on a calendar, an economic calendar, that will allow you to track this information. And then on top of that, you guys, they make it even more easier for you. They have different things and different like websites to where credible websites to where it will tell you where they think the direction is going to go. So now you can't take their word for it like 100%, but it's going to give you an estimate of what the economic data is going to be releasing, okay? And you can go kind of based off of that. And not only will they give you an estimate, they'll give you their reasoning behind that estimate, okay? So it gives you a lot of opportunities for you to be inside of the loop. So if you're outside of the loop, I truly just think that's by choice, okay? Because all this data is readily available to you, the dates and everything readily available to you months and weeks ahead of time. Now let's talk about the ways that it can be used for your benefit. How to use macro and news in your investment process. Economic calendar. Keep a simple calendar for US CPI, PPI, unemployment, Fed decisions, and major earnings, big tech names. Enter those into your trade plan. Avoid opening major positions just before high impact releases unless you have a strategy for the event. 1. Correlation checks. Regularly check short-term correlations between Bitcoin and the S&P 500 or large tech stocks. When correlation is high, treating crypto as part of a broader risk allocation is prudent. When correlation falls, crypto-specific fundamentals may dominate price. 2. Liquidity management. Major macro days reduce liquidity or widen spreads. Use smaller position sizes or wider stops when trading around news. 3. Risk scoring. Map a project's fundamental strength, team, use case, tokenomics against macro risk. Strong fundamentals can justify holding through volatility. Weak projects should be avoided or sold when macro risk increases. Example. When CPI unexpectedly slowed in a month X, markets priced in earlier Fed rate cuts, equities rallied, and Bitcoin experienced a sharp short covering rally the same day. Traders who had checked both project fundamentals and the macro calendar avoided being caught off guard and used the increased liquidity to add a high quality on-chain active projects. In contrast, fairly speculative meme coins that lacked on-chain activity and had concentrated holdings saw more violent drawdowns despite the broader rally. So as you can see, I put all that together and how it can work in your favor. You having a calendar of when these releases are going to be released. You understanding the correlation between different indices and equities and commodities and different markets that are not part of the crypto market, okay? You putting that all together, you tracking these prices, you're tracking their projects and things like that. You are going to come out on top, okay? So crypto is not that risky if you know what you're doing, okay? It's risky for people who don't know what they're doing or don't put the time and the dedication that is needed to be able to fully understand the crypto market fundamentals, okay? So that's why we have this whole entire lesson about understanding the fundamental analysis or the FA of the crypto market, because that is what is going to be able to make or break you. And again, these reports and this data is no secret. And a lot of the time, some of this data will be released at the beginning of the trading day. So if you just go ahead and you make a trading plan and you have a trading journal every day, you write down what you're trading, why you're trading it, the different news that's coming out that morning, the different news about other things that has already come out, that's going to work all in your favor, okay, you guys? And that is the key to really understanding crypto markets, is to understanding macro and micro fundamental analysis of the financial market in general. Now let's hop into our conclusion. Conclusion. FA is more than a checklist, it is contextual judgment. Fundamental analysis gives you the tools to separate durable projects from hype. Macro events, U.S. inflation and jobs data, Fed policy, geopolitical shocks, and major equity moves, especially in tech, change the liquidity and risk appetite that determine how much capital flows into crypto. Use project level FA to establish conviction and macro analysis to time and size positions. Keep monitoring both a strong project can still fall hard in a sudden risk-off move, and macro tailwinds can lift fundamentally sound in some weaker projects for a time. So in conclusion, you guys, fundamental analysis is imperative to understanding crypto markets and imperative for any type of investing that you're going to be doing within the crypto markets. You need to understand these analyses, the fundamental analysis, to understand what you are doing, okay? So again, they're going to label it everywhere, on every single website, on every single platform, how risky cryptocurrency is. But I truly believe that it's more of a risk when you don't know what you're doing, when you don't take the time and the dedication to actually understand how it works. So if you followed this lesson and you take in all this information, then you will be less likely to fall into a lot of the risk factors that come along with cryptocurrency, okay? I'm not saying you won't fall into any risk, because you probably will. Crypto is risky, okay, you guys? But I'm just saying you are less likely to fall into something that can really be detrimental to your finances. Okay, you guys? So I hope everybody understood that. And we are going to jump into lesson 5 next. Okay, so let's keep it going, you guys.